Okay, so you want to own a football club. Not just watch it, own it. Your name on the boardroom door, your signature on the transfer documents, your vision turning a struggling lower league side into something the town actually believes in again. You picture the match day atmosphere, the roar when a goal goes in, the manager shaking your hand after a promotion, the local newspaper running your photograph above a headline about investment and ambition and a bright future. You see Roman Abramovich walking into Stamford Bridge in 2003 and turning Chelsea from a decent London club into a European dynasty in under a decade. And you think that is what ownership looks like. That is what the money can do. Here is what the boardroom does not show you. The wage bill that arrived on the last day of the month and was £40,000 more than the revenue the club generated in the same period. The stadium roof section that was condemned by the safety inspector 6 weeks before the most important home fixture of the season. The star player your manager built the entire tactical system around, who handed in a transfer request 48 hours before the January window closed because a championship club offered him wages you cannot come close to matching. The supporter trust that organized a protest outside the ground because you moved the away section to generate more hospitality revenue, and nobody asked them first. The pitch drainage system that failed during the wettest October in 30 years and forced 3 consecutive home postponements at exactly the point when the cash reserves were thinnest. Owning a British football club is one of the most emotionally loaded and financially misunderstood business propositions in the country. On the outside, it looks like passion and prestige and the kind of civic pride that no other asset class provides. On the inside, it looks like a business where the product is competitive sport, which means the core output is inherently unpredictable. The labor costs move in one direction only. The customers care about results you cannot guarantee, and the regulatory framework governing how you spend, how you borrow, and how you structure the finances is becoming more restrictive every season. Some football clubs are genuinely profitable businesses. Some are sustained entirely by owner subsidy that would end if the owner lost interest or ran out of patience. And some have collapsed entirely, taking with them the history, the supporters, and the community identity of towns that built their sense of place around a football club for over a century. By the end of this, you will understand exactly what owning one of these clubs actually costs and why. What a British football club actually is. Before we talk about money, we need to understand what a British football club is as a business. Because the pyramid of English football alone contains 92 professional clubs across 4 divisions before you reach the non-league system. And the economics at each level are so different, they barely resemble the same industry. The Premier League is the product that global television audiences recognize. 20 clubs, billions in broadcast revenue distributed annually, wage bills that in some cases exceed the entire annual revenue of every club in the divisions below. The average Premier League club generates revenues in the hundreds of millions of pounds. The minimum parachute payment for a club that gets relegated is around £47 million per season for the first year out of the top flight. The Championship, which is the second tier, is by some measures the most financially dangerous division in world football. Clubs in the Championship are spending at Premier League adjacent levels in wages and transfer fees because the prize for winning promotion, worth hundreds of millions in broadcast revenue and commercial income, is large enough to justify almost any investment. Clubs that do not win promotion have nonetheless committed to the wage structures required to compete, and the resulting losses in many championship clubs run to tens of millions of pounds per season. Leagues 1 and 2, the third and fourth tiers, are where the majority of English professional clubs actually operate. These are businesses with annual revenues measured in the low millions rather than the hundreds of millions, supporter bases of a few thousand to 15,000. and wage bills that are substantial relative to income but manageable relative to the championship's recklessness. The National League and the non-league pyramid below it contain hundreds of clubs operating on budgets that in some cases are smaller than the annual salary of a single League Two journeyman professional. This conversation focuses primarily on the lower to middle professional pyramid, Leagues 1 and 2, and the upper non-league, because that is where most prospective owners actually encounter the opportunity to acquire a club, and where the economics are most revealing about what the business actually is, the acquisition cost, and what you are actually buying. The first financial surprise for anyone approaching a football club acquisition is understanding what the purchase price actually represents. When you buy a football club, you are typically buying a company whose most significant assets are its players, its stadium or ground lease, and its brand equity in the local community. You are also buying its liabilities, which in many cases are substantial. Overdue player wages, unpaid transfer fees to other clubs, historic debts to HMRC for employee tax obligations, loans from previous directors, and stadium maintenance backlogs that have been deferred for years because the cash was never there to address them. A League Two club might be acquired for a nominal sum, sometimes literally £1, if the liabilities are significant and the acquiring party is willing to assume responsibility for clearing them. The real cost of acquisition in those situations is not the purchase price. It is the capital injection required to stabilize the business, clear the debts, and bring the operation to a point where it can function without immediate crisis. That injection can run from several $100,000 to several £1,000,000, depending on the state of the club. A more established League One club with decent infrastructure, a stadium it owns rather than leases, and a genuine supporter base might cost £3 to £10 million to acquire in a straightforward commercial transaction. A championship club with Premier League ambitions, existing wage commitments, and a recent history of significant investment can cost £20 to £50 million or more. And that is before you have funded a single transfer window or covered a single season's operating losses. The stadium question is central to the acquisition economics, and it is frequently the most consequential single variable. A club that owns its ground owns an asset. The ground can be developed, mortgaged as security for financing, or sold as a last resort if the financial situation becomes critical. A club that leases its ground from a local authority or private landlord has no such security. Its ability to operate depends entirely on the continuation of that lease, and lease renegotiations can be existential events for clubs without alternatives. The ground condition is frequently the most expensive hidden cost in any acquisition. Stands that were built in the 1960s and last significantly upgraded in the 1980s are aging infrastructure subject to safety regulations that do not move because the club cannot afford compliance. A safety certificate amendment from the local authority requiring structural remediation of an aging stand can cost hundreds of thousands of pounds on short notice. The previous owners knew this was coming. It did not appear prominently in the information memorandum. The revenue streams that have to work. A football club has several potential revenue streams, and understanding how each one works and how reliable each one actually is forms the core of understanding whether the business can sustain itself. Matchday revenue is the oldest and most visible income stream. Ticket sales, season ticket income, program sales, food and beverage concessions, matchday hospitality packages. For a League Two club with an average attendance of 4,000 at a ticket price averaging £15, gross matchday revenue runs approximately £60,000 per home fixture across 23 league home games, plus cup games depending on draw outcomes. Annual matchday revenue at this scale is roughly £1.4 million before costs. That sounds like meaningful income, until you account for the costs of staging a matchday. Stewarding costs for a professional fixture are regulated by the safety of sports grounds legislation and are non-negotiable. A 4,000 capacity ground might require 60 to 80 stewards at 15 to 18 pounds per hour across a 4-hour matchday operation. Add police costs for fixtures designated as requiring a police presence, ground staff, turnstile operators, medical provision, which is mandatory, and the net matchday revenue per fixture is substantially lower than the gross. Food and beverage concessions are often run by the club on low margins or contracted to a third-party caterer who takes a substantial revenue share. Commercial revenue includes shirt sponsorship, ground naming rights, player sponsorship agreements, corporate hospitality packages, and community facility hire. For a lower league club, these income streams are real but modest. A shirt sponsorship deal for a League Two club might generate £25,000 to £100,000 per season, depending on the quality of the commercial relationships the club has built and the size of the media exposure the shirt receives. Ground naming rights at this level are similarly modest. The combined commercial revenue of a well-run League Two club might run £200,000 to £500,000 per year. Broadcasting income is distributed through the Football League and the Premier League's various solidarity payments and distribution mechanisms. A League Two club receives a relatively modest annual distribution from the Football League's central broadcasting deal, somewhere in the region of £500,000 to £1 million per season, depending on the specific distribution formula in the current cycle. This is guaranteed income that arrives regardless of league position and regardless of matchday attendance, which makes it one of the most financially valuable income streams relative to its size. Academy income and player development represent a potential but uncertain revenue source. A club that develops a young player to the point where he is sold to a higher division club generates a transfer fee. The club that originally trained that player before his career developed receives a training compensation payment. For clubs with genuine youth development infrastructure, these revenues can be meaningful over time, but are entirely unpredictable in timing and amount. The wage bill, the cost that moves in one direction. The single most important number in any football club's finances is the wage bill. And it is also the number that most consistently destroys clubs that do not manage it with absolute discipline. Player wages in professional football are not set by the market in the way that wages in most industries are set. They are set by competition between clubs for a limited pool of players whose career windows are short and whose agents are professional negotiators whose sole function is to maximize the player's earnings. A player choosing between two clubs in the same division will choose the one offering higher wages, everything else being equal. And everything else is rarely equal in the way clubs hope it will be. The wage ratio, meaning the proportion of total revenue spent on player wages, is the primary financial health indicator for football clubs at every level below the Premier League. A club spending 70% of its revenue on wages is operating at the edge of viability. A club spending 90% or more on wages is in genuine financial distress regardless of what its profit and loss account shows in any given month, because there is no buffer between revenue and wages for any other operating cost. The Football League's financial regulations, and more recently the Premier League's profit and sustainability rules for clubs within its scope, are built around controlling wage ratios and total losses because the wage bill is where clubs have historically driven themselves into insolvency. The desire to spend more on players than the revenue base supports is not irrational from a sporting perspective. Better players win more games. Winning more games generates more revenue through better league positions, cup runs, and attendance growth. The problem is that the competitive equilibrium in football means every club is making the same calculation simultaneously, which drives wages up across the board without producing proportionally better results for anyone. A League One club with annual revenues of £5 million is already under significant wage pressure. If the industry norm for competitive wages at that level requires a playing budget of £3 to £4 million, the club is spending 60 to 80% of revenue before a single administrative salary, utility bill, pitch maintenance cost, or stadium operating expense is paid. The financial fair play framework, the regulatory environment governing football club finances, has changed substantially in the past 15 years. And any prospective owner who does not understand the current framework before acquiring a club is walking into a regulated environment unprepared. The Premier League's profit and sustainability rules limit the losses any club can accumulate over a rolling 3-season period. The current threshold allows losses of up to £105 million across 3 seasons for Premier League clubs. Exceeding that threshold triggers sanctions that can include transfer embargoes, points deductions, and, in serious cases, relegation. Everton and Nottingham Forest both received points deductions during the 2023 to 2024 season for PSR breaches, and the consequences extended beyond the financial penalty to affect league position and potentially relegation outcomes. The English Football League has its own financial regulations for Leagues 1 and 2, including a salary cap system that limits the total wage bill a club can pay relative to a defined threshold based on league income. For League One clubs, the salary cap was set at a level designed to prevent clubs from overextending on wages to the point of insolvency. The regulations have been contested by clubs and the Professional Footballers Association at various points. But the underlying principle that wage expenditure must be constrained by revenue capacity is now embedded in the regulatory architecture of English football at every professional level. For prospective owners, these regulations mean that the strategy of buying a club and funding losses indefinitely through personal wealth injection is no longer as straightforward as it was in the era of Roman Abramovich at Chelsea or Jack Walker at Blackburn Rovers. Owner loans that are not equity have to be accounted for in loss calculations. The definition of what counts as a genuine commercial transaction versus a subsidized income, inflating the club's apparent revenue, has been tightened. The regulatory framework is designed to prevent exactly the model of ownership, where a billionaire underwrites unlimited losses and distorts competition. 2 scenarios. The honest numbers, the good year. You own a League One club with revenues of £6 million. Matchday income at an average attendance of 7,000 runs, £2 million. Commercial income has grown to $900,000 after a successful sponsorship renegotiation. Broadcasting and solidarity payments total $1.2 million. Academy players' sales generated a £1.9 million windfall when a youth product moved to the championship. Your playing budget was managed at $3.4 million, 57% of revenue before the academy sale. Operating costs, including administration, stadium maintenance, and non-playing staff, ran $1.8 million. Net surplus before owner drawings, £800,000. The club is financially self-sustaining for the first time in 6 years. The manager has just signed a contract extension. Promotion looks possible. The bad year, the January transfer window. Your top scorer, who has 12 goals in 22 appearances, has attracted championship interest. His agent calls on the 14th of January. The player wants to go. The offering club's bid is £800,000, which is reasonable market value. You need the money. You sell. The team wins 4 of the remaining 21 games. You finish 16th, 2 places above the relegation zone. Attendance drops. Season ticket renewals in the summer are down 18% compared to the prior year. Commercial sponsors renegotiate downward, citing reduced exposure. A structural survey of the main stand identifies remediation work costing £380,000 that the Safety Authority requires completed before next season. Total revenue for the following season projected at $4.8 million. Playing budget cannot be reduced without further harming the competitive position. You fund the gap from your own resources. This is the second year in a row you have done so. What the owners who survive do differently. The football club owners who build something lasting rather than simply sustaining losses until patience or money runs out, share several characteristics that are visible in hindsight, even when they were not obvious in prospect. They treat the academy as infrastructure rather than overhead. The development of young players is the one area of a football club's economics where the investment is genuinely patient capital that can produce extraordinary returns. A player developed from age 10 to 18 at a club's academy and sold at 18 to a Premier League side for £2 million represents a return on an investment of perhaps £40,000 to £60,000 in direct development costs. The clubs that consistently generate academy income have built a sustainable competitive advantage that does not depend on owner subsidy. They build community commercial relationships that reflect the club's actual social footprint rather than its footballing ambitions. A lower league club that is genuinely embedded in its community, that operates coaching programs in local schools, that partners with local businesses in ways that generate genuine commercial value for both parties, that uses its brand to support community health and education initiatives, is building a commercial ecosystem that produces more durable revenue than a single shirt sponsorship deal negotiated on pure market terms. They manage the wage bill before it manages them. The discipline to say no to a transfer target whose wages would push the ratio above the sustainable threshold, even when the manager is convinced the player would make the difference between promotion and another season of consolidation, is the single most important financial discipline in football club management. The clubs that have consistently avoided financial crisis are almost uniformly the ones where the board has maintained genuine control over wage commitments, rather than allowing the manager's sporting ambition to set the financial exposure. The honest conclusion, owning a British football club is not a financial investment in any conventional sense. The return on capital is in most cases negative. The revenue ceiling below the Premier League is defined by geography, supporter population, and broadcast distribution formulas that individual clubs cannot meaningfully influence. The cost structure is driven by a labor market, where agents and players have more negotiating leverage than clubs, and where the regulatory framework is designed to prevent the kind of owner subsidy that once allowed wealthy individuals to buy their way to success. What a football club is, honestly, is a community institution with a commercial wrapper. The commercial wrapper has to be managed with genuine financial discipline, or the institution eventually collapses. The community institution is what gives the whole enterprise its meaning and its durability when the finances are managed correctly. The clubs that survive and occasionally thrive are the ones whose owners understood from the beginning that they were stewards of something that existed before they arrived, and would need to exist after they left, and who built the financial structure of the club around that long-term perspective rather than around a promotion ambition that the revenue base could never actually support. The ones who fail are the ones who walked into the boardroom thinking they had bought a football club and discovered too late that they had actually bought a wage bill, a stadium maintenance liability, a safety certificate problem, and a supporter base that would hold them personally responsible for every result for as long as they remained in the seat. If the real economics of sport, business, and money are what you want to understand at the level they actually operate rather than the level they are usually presented, the Money Framework British channel is where that conversation lives. Subscribe to Money Framework British, turn on notifications, and join us for the next breakdown. Because the most important financial lessons in sport are never the ones that make the back page. They are always the ones happening in the boardroom.